Welcome to this community talk. This is the first time we're doing this. I guess we did one on Ethereum, but I wasn't able to join, so I've got no idea how that went. Could have listened to the recording, but I only did like half of it. So I thought like maybe we can try this new thing. So the background is, if you don't know, we create Tokenomics 101 articles, right? And we do that for protocols that interest us. And so we write an article, we have a template for that. So we try to analyze them all in a similar way. So we try to look at what the protocol actually is, maybe a little bit about what their business model is, look into what the token does, describe the different mechanisms, look into distribution unlocks of the token, then figure out the demand drivers and the value creation and value capture. And that's kind of what these articles about. And yeah, if you go to our website or to Substack, you'll see there's a whole bunch of them that we have created that we've gone through. And yeah, so we recently had this thought like, okay, what are we doing with these articles? We publish the articles, then we do a Twitter thread mostly on them. We do a walkthrough video of the diagram sometimes. So why don't we just add this on top as well, that we do a talk? Maybe like people are interested in discussing the tokenomics and figuring out about the protocol, or just join in on a conversation about it. So this is the idea of this talk, right? I want to just maybe walk you guys through dYdX to start with, not too long, just like a little bit, then and then together with you guys figure out what maybe an investment theory for it could be. So this is something we've been thinking about. That's kind of missing in our Tokenomics 101 pieces because they're currently just their analysis of the technology of the tokenomics. So, but something that we could add and that we've been thinking of is to also analyze maybe the catalysts for investment, the drivers for that, what could happen with the protocol in the future, to help people to form an opinion on that. So maybe that's something we can dive in today. I've got a few ideas on it, and yeah, maybe also talk about protocol improvements. So that's kind of what we want to do. So maybe I'll just start, maybe like 10 minutes or so. I'll try and walk you through dYdX. And ideally, if you guys want to follow along, I've got this article. I've got no idea how to send a message here. Yeah, I'll post it in general. This is just the piece that I'm talking about on Substack. So dYdX, right? If you don't know, it is kind of an exchange that allows you to trade with leverage, perpetuals. So there's like never-ending futures contracts in a way. So you can do that on dYdX. You can log in to the platform and take on great amount of leverage to pile into ETH and long the merge trade or whatever, or short something. That's kind of what you could do with that. And the specialty is that they are somewhat, the exchange is like somewhat decentralized, but they've got an off-chain order book that's running. And they also have like a centralized entity that takes care of a lot of the stuff that runs in the background, i.e. managing the protocol, taking in the revenue streams. And yeah, so that's kind of an off-chain centralized component, the dYdX foundation that they have. Yeah, that's kind of what the protocol does, right? They have this order book and matching engine that's completely off-chain. So not like Uniswap, where they have an automated market maker. They really have an order book. And I think the benefits of that is just like faster execution speed for traders. They can tap into institutional liquidity. So those are just, I guess, some of the benefits that what they're currently doing gives them. Now they're going to change a lot of things. They've announced this in June that they're working on a dYdX version 4. That's going to be like standalone based on the Cosmos blockchain. So they're going to move away. Currently they're running on Ethereum and I think also on layer 2. Could be that they're only running on layer 2. But yeah, they're trying to go onto the Cosmos ecosystem and build their own standalone blockchain, doing all of this, and they also want to decentralize the order book and the foundation. So a lot of these components that are currently decentralized, they want to they're currently centralized, they want to decentralize them. So then, with that in mind, maybe let's look at the token. So I've just opened up this diagram that I've made for this, and in the diagram you'll see there's the dYdX protocol. So basically, if you log into their website, that's what you see. You have this decentralized exchange. You'll deposit some funds, some DAI or USDC into a smart contract onto their exchange, and then you can start trading, right? So you can take on leverage and put on a trade. And what happens then, basically, this trade is then put to this dYdX Trading Inc., which is the foundation, run against the order book, and your trade sort of gets executed, hopefully, or you can, depending on what you set up, that will happen. And then the trader, for doing that trade, they pay a fee, as usually this goes. The fee is paid to the dYdX Trading Inc., and they'll basically keep this in a centralized entity. So this is something like super interesting that we try when we analyze these kind of protocols, that we look at immediately, like what do they do with their revenue? How do they make money? And so obviously, if you have a governance token, and dYdX is supposed to be a governance token, and if what you govern over is actually just a treasury of tokens that you yourself have minted, the value prop or the demand for this governance token, in my opinion, isn't or can't be that high. It can't be that good, right? It would be different if the treasury would be accruing or would be collecting that revenue that happens. And that's really something that I think they're going to implement in version 4. So that's when this whole dYdX thing could become a lot more interesting. So anyway, and that's how the trading goes, right? You put some money in, you trade, and then you pay a fee for that, and that fees goes to the Trading Inc. And that's really all, right? It doesn't have that component of Uniswap where you have liquidity being provided, because the liquidity is provided to that centralized entity. So they have like professional market makers in there that provide liquidity that do the trades with an order book. And that pretty boring in itself and what it does. And then I guess there's a foundation involved sort of in this whole play. They take care of software development and building a brand and stuff like that. And then there's a dYdX community that has some governance power and decision power over the treasury. But like I said, the treasury is filled out of the Genesis supply and then not used for anything else. So it's kind of similar like to Uniswap, I guess. Where the Uniswap treasury received a ton of Uni tokens, and the Uni holders can govern what to do with the Uni tokens, but there's no new tokens coming in. And I guess, that's, I don't know, I wouldn't want to, I mean, it's interesting to govern over it, but it's sort of, it's kind of like a closed loop, like a circle. There's no new money coming in that you're going to govern over. Anyway, guys, if you have any questions while I'm talking, please feel free to raise your hand. I'm happy to give anyone the microphone to come up and just talk about stuff as we go along. But in the meantime, I'll just continue, right? So there's those are basically the things. Then they've got 2 other interesting mechanisms. There's a safety module. I think Aave has a similar safety module type. And you put in tokens and they use that in turn, like for shortfall events, like when there's like smart contract risk or things like that. And you deposit your dYdX token and you receive more dYdX token. Now if that mechanism really makes sense, I don't know, and I don't really think so. Like, why wouldn't you use an uncorrelated asset to back that, right? Because if if there is a shortfall event, a smart contract risk or something happening, then wouldn't the token go down anyway? And then wouldn't it be dumb to then release more tokens to use that safety module for that? Wouldn't you like rather hold USDC, right? So for me, this seems to be something just to give the token some utility. But anyway, Kaiser, you had a question.
Yeah, so basically, I just wanted to ask a few questions about tokenomics. So, is it would it be like appropriate for me to ask it right now, or should I keep my questions for the community of dYdX?
Like generally about dYdX, or do you have like general tokenomics questions?
No, I have questions regarding Tokenomics DAO, the whole server and how it operates and what can be done and everything.
Oh, okay. Then let's please park that and take it offline. Please feel free to ping me or Mason or Lovis, and then we can sort you out in terms of your
Okay.
questions. But because this talk is really only about dYdX. But
Sure,
thanks for
sure,
reaching out.
sure.
Yeah, cool.
Sure.
Let's take this offline.
But I have heard a lot about dYdX community. If you can just give a very brief introduction of dYdX, how it is and what it does, would be great. Thanks much.
Yeah. We pretty much just did that. So it's a perpetuals leverage trading decentralized protocol, and yeah, that's kind of what it does. It allows you to trade with leverage. And so maybe let me get back to where I stopped. Right, we have the safety module, and the safety module, you'll stake your dYdX token and earn more dYdX token, right? So this like what Kobe in one of his pieces titled like for ApeCoin, like the death of staking. It's not really staking. I don't know why they even are allowed to call it staking or call it staking, because staking for me is when, I mean, in the sense of the safety module, yeah, maybe you have a little bit at stake, but yeah, it's still a weird mechanism that seems to be designed for giving the token some artificial utility. Okay, so then there's the liquidity module. That's, I guess, like another part of this whole dYdX protocol. Liquidity module is really for their own liquidity, so that they can provide liquidity for trading pairs of USDC and dYdX, right? So there's some Genesis supply that went into the liquidity pool, dYdX tokens, and then token holders can deposit USDC and earn a yield in dYdX, right? And they're presumably going to deposit these token pairs on decentralized exchanges like Uniswap or SushiSwap. Yeah, so that's kind of what that does. And yeah, I guess the only really interesting mechanism is the mechanisms that traders, so the people that go to the exchange and put up trades, like they pay a fee, right? That's what I said in the beginning. So that they, by holding tokens, they can reduce their fees. And so that's really interesting if you think about like what this would be applicable for. Of course, like if you're really just like a retail trader and you trade like a very, very low volume, this wouldn't be that interesting. But for people who trade a larger volume, this could be an interesting case for holding dYdX tokens, right? Because like the more tokens you hold, the more reduction in trading fees you'll have. And then there's also a token incentive. So they'll pay you tokens based on the trade volume you put through, right? So and that's an interesting mechanism if you think about their value creation, right? They, of course, their revenue stream is collecting a portion of trading fees. So they want to encourage as much trading as possible. So they're going to pay token holders that do a lot of volume, pay them some tokens. And I'm sure they have calculated this out so that the people who hold some dYdX tokens, they have to pay like a reduced fee. So yeah, that's kind of what the token really does. I see the major demand driver for the token generally being this reduction of transaction fees, and then maybe a little bit on governance, but that's it. And the value creation or the value capture, is sort of in line with that, right? You have this decentralized trading thing, and you and kind of the token sort of is held by more users if more people trade and want to reduce their fees. That might be like a theory for how the token accrues value. And then maybe just like one last thing before we can start talking about or discussing is the distribution on locks. They've got like a fairly normal distribution of tokens, and the only thing is that like it's vesting over a time frame of 4 years. How many tokens they have? Got about it somewhere in the diagram. It's a billion tokens, and they're vesting over the time frame of 5 years. And currently, or like when I wrote this piece, they had like 100 million in circulation, which is not a lot, right? So that, and if you like to a billion, that's like 900 million additional tokens, if my math is correct, that are going to enter circulation in the next 5 years. So that's going to be really interesting to figure out and see where this goes. So yeah, I guess like, are there any questions to that? Are there any ideas in terms of investment theory or improvements for the protocol? What could be done with it? Please feel free to raise your hand and step up and bring that in. While we do that,
I guess
to me,
just one point that I'm wondering. So currently, dYdX is operating from an order book, right, with professional market makers in the back. But then their goal is to be fully decentralized by the end of this year, which is pretty soon. So does that include trading then based on liquidity pools, or is the order book going to stay, or is that going to get decentralized as well? Do you know?
I think from their announcement, they're going to keep the order book, but they're making it off-chain. So the announcement says, rebuilding dYdX as a standalone Cosmos-based blockchain featuring a fully decentralized off-chain order book and matching engine. So to me, it seems like it's going to be somewhat off-chain, but decentralized. No idea what this really means. But it sounds, to me, this sounds quite interesting, right? And then I think I also read somewhere that this whole upgrade includes getting rid of the dYdX trading inc, or like moving that into the background. And from an investment perspective, right, if now the governance or the token not only governs over a treasury of dYdX tokens, but it now also governs over a treasury that has trading revenue flowing into it, it becomes a lot more attractive. If that happens, right? If they move to that new thing.
So that means possibly with that update over time, the token, basically they maybe launched a token to have it, and they'd launched a product so that they can essentially bootstrap to the point where they're much more decentralized, and the token ends up being, I guess, more like a revenue share. Like, I guess there's like some sort of promise of a dividend then at that point.
They don't have that yet. They're talking about, but I mean, like, if you have the power to govern over a treasury that has, so maybe one interesting point, and I'll mention that in the article. I went to Token Terminal, and Token Terminal is a website where you can see kind of the revenues that different protocols have. And dYdX is third among decentralized applications, right? It's like LooksRare, OpenSea, and then comes dYdX. Now, this is revenue, it's not profit, but anyway, like there's like 200 million or so that they have over 6 months. And that revenue goes to the trading inc, right? A centralized corporation. So the token has no real attachment to that. But what if they now put this into the treasury? This like 200 million half a year revenue, right? Then the token all of a sudden becomes a lot more attractive, because if you can decide what happens with that treasury, that gives you power to influence certain things, like how that money's spent, maybe, right? I don't know to what extent they're going to enable that, but that's just what came to mind, right? There's this kind of like catalyst approaching when they're moving to this new thing. that could include a change in tokenomics. And yeah, in terms of in governance power too.
Can you guys hear me?
Yep.
Yes.
Oh, cool. Okay, it started working in. Cool. So I just wanted to sort of like I guess like the demand for the token is sort of like directly mapped to the amount of people that are gonna want like to get a discount on trading, right? Currently, at least.
Yep.
Yeah.
I see that as a main driver.
Yeah. Because like I don't know if they detail anywhere, like you mentioned, like what extent the governance has, right? As in, does it actually, do you have the ability to change, I guess, the direction of current, I guess, yeah, infrastructure, or can it just be sort of like to say, well, maybe we should use the treasury assets to develop such and such?
Yeah, so currently the token can decide over what happens with the treasury, and they can make proposals into software development. But I could assume, like, if they want to decentralize all this, I can assume that that will change, right? That there's going to be more of a governance process involved, and they can maybe even decide, not just input ideas, but also decide.
Yeah.
Yeah.
Yeah, I mean, I guess that is a concerning point in like the growth, as in, like you say, if the supply is going to 10x until it gets to max supply, then that demand has to absorb that supply in somehow.
Yeah.
And I mean, currently, that directly maps to the amount of users that, well, directly, I mean, it somewhat maps to the amount of users that are going to sort of be heavier users in there. I mean, because, like, for example, if you don't trade much, it probably doesn't make sense to hold tokens, right? I mean, it only makes sense if you are sort of like a full degen. And so, like, the demand for that is going to have to absorb that supply is directly mapped to people that are going to be more engaged in trading, right? Which is a pretty small category to be aiming at.
Yeah. I wonder how they would have modeled this or simulated this out.
Yeah. I mean,
Like, because it sounds weird to me, right? Like that they're gonna have like 10x their token.
Yeah.
Circulating supply from here. Like how are you gonna 10x the amount of trade volume? Or people holding your token, and the only demand driver is really that you can reduce your fees.
Unless, like Lois said, maybe there's like a dividend in the future.
Yeah.
Or I mean, with the next, so I suspect that they're trying to decentralize and maybe even keep the order book off chain so that there's not so much transparency also for regulators. Leverage trading is always controversial, right? So because it typically retail investors, like normal investors, like you, all of you guys and I, unless you have like some crazy credentials that nobody knows about, we just lose a bunch of money using leverage, right? So, but it's great for exchanges because they can make a ton, especially if they have the order book. That means they're the counterparty to the trade, and just like in a casino, usually casino wins, right? The house always wins, they say. So when I hear there's a foundation involved, most likely it's in Panama or somewhere else, where there's very liberal jurisdiction. And so this is all speculation on my end, just from listening to this. I have a strong feeling that this might become like a really like a gray area sort of exchange, and they're maybe trying to take the space of BitMEX or Deribit, some other high leverage exchanges, where like the regulators are slowly cracking down on those. And then with the next bull market, I could easily see that they can 10x, maybe even 100x their trade volume, if that really happens. But that's all speculation, my opinion, just my interpretation. No idea if that's true or not.
I mean, that somewhat aligns with, I guess, like the move to Cosmos on like the play of sovereignty and whatnot. But yeah, speculative.
Yeah, I don't know. So you wrote a bunch on Cosmos, right, Mason?
Yeah. I mean, it does make sense. Like, I think the reason, there's another tweet actually from the dYdX founder that I can't find currently, but he sort of went into more detail as to why, and it was more along the lines of scalability issues. Now, it does make sense too, the fact that if you are a Cosmos chain, you have a lot more decision-making power over like everything that you do, right? So that I think is also important, but it sort of like depends what type of application you are, right? But that's why I said it sort of makes sense with regulation, maybe.
So it's like all a regulatory thing that they're doing.
I'm not sure. I don't know. I just meant that they have more power to like decide over every single like point, like every all the way along the stack, I guess you could say.
Yeah,
and they don't
yeah.
have to sort of confine to what Ethereum sort of wants.
Or the layer 2. I think they're on some layer 2 Arbitrum or
Yeah.
Optimism. One of those.
Maybe, and that also is because if they're going to become a Cosmos chain, I guess that is another demand driver in that I guess maybe dYdX is going to be the gas token. So you would have like somewhat of a demand based on just usage.
Mm-hmm. Yeah, they're their own blockchain. Is that how they work on Cosmos? You just have your own. Every sort of chain
You're a
has their own token.
standalone. Yeah, you're a standalone chain. Yeah, like Osmosis is like they want to be like the DEX. The idea is that, for example, in Ethereum you have like this base layer, and you've got applications that are built on top of it, and they sort of have to confine to certain aspects of that chain. But then in Cosmos, it's like this ecosystem where each application is its chain in itself, right? And they use their own token as like the gas token. So I guess from that point of view, the demand for dYdX doesn't have like it's actually better because then it isn't simply dependent on, I guess, like heavy traders just wanting a discount. It could actually map to just like normal people who trade not too frequently, but also need to pay gas, right?
Yeah. But then they would. I mean, that wouldn't be their revenue. They would have to pay that to, because it's proof of stake, they would have to pay that to stakers, right?
Yeah. Yeah.
So it wouldn't really.
I guess it's. Yeah.
I don't know, kind of give the tokens like some utility so you can use it to pay for transactions. But that's if you come from Arbitrum, where I guess it costs like almost nothing to trade. That's almost like a downgrade.
Yeah, possibly. I mean, like in Osmosis, for example, they do have free transactions, and the idea is that if you don't use it that much, you just use free transactions. But then, if you want stuff done quicker, and you just tend to start using the Osmo token, just because it's better, right? It's just easier and quicker for you to get stuff done.
Yeah.
So in that aspect, I guess it could even be better than Arbitrum for like lay users.
Okay. Yeah. But then the institutional or professional traders, they would potentially have to pay more.
Maybe. I'm not sure. I don't know. I've not really thought about it.
Okay. Yeah. They also have some forum discussions going on like implementing a voting escrow token and gauges to distribute rewards. So yeah, that's also something where I thought like this could be quite interesting for the protocol. Right? It's like in Uniswap, the fee switch. Right? I think everybody's trading Uniswap based on this assumption.
Yeah.
Because I think they're going to implement a fee that then accrues to the treasury. And so for them, maybe it's something similar here.
Yeah, and like especially if you compare it to like GMX, for example, which does something similar, but the way they go about it is quite different, right? They have like the GLP stuff, and that, like Lovis said, I mean, the house tends to win, right? And that sort of, it benefits people quite differently. And they also have, so I think if you're, for example, a holder of the GLP token, which is just a basket of assets, right? That traders trade against. There's a benefit to holding that, and then I think from holding that you get some form of escrow GMX or something like that. It's slightly different than the curve model, but you do get a token that has a better demand driver, like it has a better demand mechanism rather. So yeah, I don't know, and like I don't know which I would sort of like say is gonna be the winner, but like they both seem to be taking quite different approaches, really.
Yeah. Well, at least it's not a Ponzi, so that's good.
Yeah.
It doesn't seem to be. It seems to be like pretty normal. Also not too crazy. I think what they could work on is the value accrual part, right? That the token has something for it, maybe through governance. I don't know. But aside from that, yeah.
Like,
not
so
true.
what advantage would there be over a traditional exchange like that allows for perpetuals?
Yeah.
Is
No
there
KYC?
Okay,
Yeah.
no KYC.
I guess that's the main.
I recently read on Twitter that they have announced something, some form of,
Oh
I don't know if
yeah,
it's exactly KYC, but I saw that and people were upset about it. But I forgot what it
yeah.
was.
It wasn't compulsory, but yeah, it was.
Yeah, it's like fingerprint kind of thing. I remember. I can't find it now, but I think they said something on that. But yeah, I don't think you have to KYC. And so with centralized exchanges, yeah, you definitely do.
Yeah, I found the tweet that they're apologizing, so I'll just post it in the.
Okay.
No, wrong link.
What so sorry, I didn't catch it earlier. What can you trade on there?
Like ETH, futures, perpetuals, general leverage.
But ETH is like the main token you can trade.
No,
I guess.
like all sorts of tokens, I think.
Okay.
You're like Bitcoin. Because they have this they have Ethereum, Bitcoin, Cardano, Bitcoin Cash, Dogecoin, Chainlink, Solana, Monero, and then a whole bunch of ERC20 tokens.
Okay.
Yeah. Yeah, without KYC, I think that's the main advantage, the main benefit, right? Low fees or no fees is what they say. Deep liquidity, up to 20x more buying power. Yeah. I think, it's an interesting thing, but to me, like the main thing of concern is this, that there's only 100 million tokens in circulation and they have 1 billion of total supply.
The white gap.
And and so then in January 2023, they have like a huge unlock coming up. That's going to be interesting. I'm not a trader, so I've got no idea how this would work, but it just, if you look at the vesting chart, it just goes like hockey stick from January onwards. So that's I think that's the date to watch out for.
And I suppose that's why they scheduled the announcement for going more decentralized around the same time, right? So hopefully
that would bring some demand in some form. Yeah.
Well, best of luck to them.
Yeah.
It's a. I mean, it's cool. I mean, it's a cool project overall. Just curious to see how it'll shake out. I just actually coincidentally just saw a tweet where somebody said that these decentralized exchanges that allow leverage is one of the most common and like biggest, what did you say, like biggest, fastest growing DeFi application. But they're
Cool.
all very similar, right? So there's not, for traders, there doesn't really seem to be much incentive to stick with one or the other. So they'll probably just go take their orders, I guess, or whatever business they bring, just take it to whichever exchange treats them the best. Be very similar,
Other lose
probably
fees,
to.
yeah.
Yeah, exactly. It'd be very similar to I guess stakers or liquidity providers just go wherever the APY is the best, and then there's not really much holding them there, right? So it'll be.
Yeah, yeah. I think it's like a really low margin business, almost like, all right, so you cutthroat. Somebody can just spin up something similar, and as long as it
Yeah.
has the liquidity, yeah, people can go and use that. But yeah, I think like through this centralized thing, they might know a lot of people or have good connections to, institutions that have liquidity and provide it to their order books.
Yeah.
So they can
Yeah, I
use
would
that.
think so.
Yeah.
Yeah, because if it can you hear me?
Now.
Okay.
Yep.
Okay. Yeah, because if it isn't like community sourced liquidity, then I mean the slippage shouldn't be bad, right? And if it's going to be deep liquidity provided by institutions, then traders are going to go where there's less slippage, right? So maybe that is an advantage of currently having like an order book with deep pockets,
Which is centralized. Yeah.
yeah.
Yeah, possible. Might be. Yeah. Yeah. That could be like one of the benefits of this. Yeah. So what are the competitors? You said GMX?
Yeah, GMX. What was the other one called now? One sec, I'm just gonna think. Yeah, I think it's this one. Yeah, Perp. I've not looked at this whatsoever, but I just know it's posted it
Okay.
in
Yeah.
general. Perpetual protocol.
Okay.
I have no idea how it works or anything. I'm not sure of their model or anything like that. But it does say provide liquidity there, so I guess that's slightly different.
Yeah, it seems like more of a decentralized classic approach.
Yeah.
Okay. Yeah. Maybe it'd be cool to do a comparison because like,
Yeah.
I mean, what is really interesting is that they seem to be doing well in terms of revenue, right? Like so this token terminal thing, they're doing a lot more revenue than GMX. Now I don't know how they measure it. It's like I read this article a while back that you can't really trust these numbers here. But anyway, like there must be a reason for why they have so much more revenue than GMX. Maybe it'll be interesting to see the trade volume for both of these, but I'm not sure if they disclose that kind of information.
Yeah. Yeah, comparison would be pretty decent actually.
Yeah. Let's see.
Maybe that'd be the next call.
Yeah. Oh, their volume over the last. I'm not sure if I can trust this, but that's 860 million over the last 24 hours. Let me see if I can find like a comparison of these volume. Oh, there's just too many. I can't really filter. So you've got Binance, and then a long wait until I find dYdX on place number 39. And yeah, GMX seems to be lower than that, but I can't find it. So yeah, anyway. Yeah, maybe we can do that. Is there, do we have anybody working on GMX? I think that'd be an interesting one to write about.
Yeah, we do
I remember
actually.
hearing it. Okay.
Somebody, one of the Drow members, is currently working on it.
Okay, nice, yeah. Well, hopefully that that gets finished. That'd be cool
Yeah.
to see how that works.
Yeah, then we could do like
Anyway,
a comparison video.
Yeah. Do we have any questions, comments, anything on this dYdX talk on the protocol? Well, okay. There's one. How do I? Oh, Lobus nodes.
Hi. Yeah.
Hey.
Hey, can you hear me, guys?
Yes.
Great. Well, I joined the call late, so sorry if you covered stuff that I might be asking about. But essentially, dYdX, their inspiration for the business and how they operate obviously comes from brokerage firms, in a traditional market like trading firms and whatnot, right? So there are plenty of those available in traditional finances. I mean, this is how they operate. This is how they work. I mean, pretty much, I don't know if you're familiar with, let's say, interactive brokers, right? There's a big one, for instance, in traditional finances. So essentially, that's what they offer. I mean, they have built their platform pretty much inspired by those pioneers, in the traditional finances, and they try to sort of offer similar products with within the crypto, right? That's what it is.
Yeah. That's what it is. But and because there are so many different products, I guess, in the crypto space that cover trading, they really focus on perpetuals, futures, and I don't know what else.
Right,
Yeah,
but when you say futures, I mean, you don't mean like CME futures for Bitcoin and ETH, right? I mean, you mean futures, their own futures, right? I mean, dYdX futures or Binance futures, those kind of futures products, right?
What's the difference?
Well, the CME, that's the exchange in Chicago, right? So where, and over there you have, I mean,
they don't trade Aave, right? They don't trade like futures on Aave. Yeah.
No. They have, I mean, they have
I
within,
think Bitcoin, right?
Exactly. They have Bitcoin and ETH, I think, and they have like two sizes, you could say, of futures contracts. There is like a standard and I think mini or micro. I can't remember what precisely the name is, but essentially, I mean, they are regulated products, right? They are traded the same way as wheat futures, oil futures are traded, right? So obviously those are highly regulated. There is, deep liquidity for those futures and whatnot. So over there, when you trade, essentially your trade goes to the actual exchange, right? It's being, traded. Obviously, the broker facilitates the trade, but then there is, a buyer somewhere in the world or seller that that you basically buy or sell to. So those are like the futures that are regulated. But then the futures dYdX offers are essentially what probably Binance and other centralized exchanges have, and they kind of draw on that. That's how they kind of offer their products.
Yeah. Thanks. It's definitely their own, right? They have their own order books, market makers, and they have their own liquidity providers. So it's completely isolated, I guess, from
it must be
Binance or CME or anything else.
Oh, right.
It's just their own trading world.
Yeah. So definitely, I mean, that comes with risks in a way that essentially, I mean, they decide, or dYdX decides all their terms and conditions, right? Of basically whatever happens, all the trades and how they happen. And I mean, they can, I guess, okay, well, it's not, is it actually blockchain. No, it's they have their own side chain. They operate on
No,
a
it's
side
completely
chain, aren't they? Yeah,
currently
it's
it's off
completely off
chain.
chain.
Yeah.
Yeah. And
Yeah.
then, but then I imagine at some point the trades, I don't know, when they close the day, I mean, the trades are then settled on chain. So, whatever happened off chain within their own environment ecosystem is then the information is then moved to on chain. I mean, that's how they do that, or that's, absolutely off
No,
chain.
I think it all happens off chain, and and I think I mean this is not a like cross chain or anything. I think they just keep different wallets of like Bitcoin balances and Ethereum balances. So if you trade these, you won't get that paid back out, but you will get paid out the difference, right, in USDC. So I think everything is just settled in USDC on Ethereum, and that's what you get. And yeah, probably they then have some mechanism to settle between an Ethereum or Bitcoin or whatever to settle that off chain.
Yeah, I mean, I would imagine again. I haven't explored so much the futures, the futures contracts that dYdX offers, but in traditional finances, I mean, you trade the futures for peg. Obviously, the settlement is in most likely US dollars. But then every futures has this kind of settlement date, right? Because futures is a contract that has expiry date, and once you have crossed this settlement date or expiry date, then the exchange will ask you, all right, well, please provide us with oil tanker here and there because you have, I don't know, 100,000 of barrels of crude to receive on that date, right? So I'm just wondering if dYdX also offers that you can actually choose to have your contract settled in the actual, the crypto that
No, I don't think so.
you trade.
No.
Okay, you don't think so? Okay.
Yeah, because that would like the way I can log in here, right? If I go to their site, I can log in with MetaMask, but I can't connect with any like Bitcoin wallet, so I can't deposit Bitcoin. So I don't think, and I mean, this would be like a completely new set of technology involved, right? Like a decentralized cross-chain exchange. That's possible, but I don't think they have that in here. This seems way too complicated for that.
Yeah, usually those. So just I'm familiar with BitMEX and Deribit, the centralized exchanges offering similar product, and they will always cash settled. So they call it cash settled, but basically it's settled in the same asset that you're trading. So you can you can transfer ETH in, and then you can trade ETH with it. And if you do futures or options or just perps, your gain or losses are just credited in ETH. And same for Bitcoin. But then on Deribit, same exact thing, but you had to transfer in Deribit and Bitcoin, and you actually couldn't. You could for a long time you couldn't even convert between the two. You had to literally fund the account separate. But I don't know if dYdX does the same. But I'm sure they're doing the cash settlement because
just in USDC on ETH. So you can deposit USDC on ETH. You can do a perpetuals contract in Bitcoin, and then if you want to withdraw, you're going to withdraw USDC on Ethereum. So you never actually touch Bitcoin, I think. It just happens in their order books.
Yeah, so essentially what they do is pretty much accounting and settling the difference, right? To your account.
Yeah. Exactly. That's it. Yeah.
Yeah, that's interesting. I mean, but yeah, certainly I'm just thinking. So, and you guys mentioned they offer lever trading. So I imagine, you have to provide the margin, and then you can trade as long as you maintain the margin, right, for a given product.
Yeah. That's how it works.
Yeah. So, because what is interesting, with margin trading is like, let's imagine, I open a position with a margin. My margin is, let's say, 1,000, USDC, to trade. What I think the leverage is up to 20 times you mentioned. So that would be 20K, right? Worth in whatever, let's say ETH. And then there is, a crash in the market. If price declines, the question is like how fast they can liquidate your position, because that can happen, that you actually that the loss on your position wipes out your margin, and then it goes negative, and then who takes the hit? Is it dYdX or is it you? I mean, you're anonymous,
It
right?
can't
You
be
don't
you
do
because you don't.
KYC.
Yeah.
Yeah, you don't do KYC, so there is a risk for dYdX there, right? So I mean, how fast they can liquidate those positions if there is like a sudden event in the market, right, where the prices, can go both directions, up and down, because you can go short and long, right? So
yeah. No, good point.
So
could be the case. Yeah, but it can't be the user because they are there's no KYC.
no, exactly. Yeah. So it is dYdX. So the crucial, I guess, for the success of a big risk to mitigate is like how fast they can liquidate positions if they run out of margin, right? Those accounts.
Yeah.
Is that where the safety module comes in?
I think the safety module is only for stuff like shortfall events, like smart contract risk. I'm not sure where they always say like shortfall events, and then they kind of define it as smart contract risk. So this would have nothing to do with liquidating trades.
Yeah.
Anyway, really interesting.
Yeah, so
to think about from that
I
perspective.
just wanted to share some of my experiences, basically, from traditional financial markets and how that might be translating into dYdX, because essentially this is what they're trying to do. They're trying to kind of mimic what brokerage firms doing in the traditional market. So.
Yeah.
So no, sorry, I didn't want to kind of go too much, or derail the conversation too much. I was just curious if you guys knew how.
Interesting insights. Anyway, yeah. And I guess like we were about to finish off. We were like the last question. So yeah. Thanks a lot.